Hello everyone, happy Independence Day to our American audience. Hope you're doing well. Welcome to another episode of Monday Markets brought to you by the FTX app. Links available in the description below. The best mobile trading and portfolio tracking experience available on the market. Let's talk about the market. So, higher time frame stuff, we'll keep it short, keep it relevant. The market is still more or less glued to the prior cycle all-time high at around 20k. That's sort of where the churn has been taking place, and where volatility has kind of dampened and slowed down, which is not a terrible sign. But that's all we can really derive from the quarterly or just the really, really high time frames. It's the worst quarter in Bitcoin's record history, whatever. So it's not the type of thing where you expect a fresh trend to emerge straight away, but it's still interesting to see the relevant inflection points. And as you can tell, if this prior candle high or just the previous all-time high isn't good enough, then we're left with the same existential panic longs deeper into previous cycles levels at around, 14, 13, 12, 11, 10k, whatever. And that might seem a bit extreme to kind of group together 14k and 10k, because if you buy 14 and the market goes to 10, then on a percentage basis, there's quite a big difference there in that trade. But structurally and practically speaking, it doesn't make a difference from a trading point of view, especially from like a spot allocation or the type of structure you're trading, because you essentially have two choices, right? Presuming you want to buy crypto at some point. You either do it at less extreme versions of previous cycles levels like 20k, or you do it at more extreme versions of previous cycles levels like 14, 12, 10, whatever. And those are the two choices that we are confronted with, and the two most important variables for where to get exposure. I think anything below that just starts to look frankly bizarre. Like if the industry has been snapped in half at 20k, then any meaningful time spent below monthly support and the two lower lines you see, the mind kind of boggles as to what the state of the industry would look like. So if it gets there, we all take more or less the same existential do or die, is this a failed experiment panic longs. If it doesn't, happy days. So the distinctions there, while the percentage difference might be quite big between 10, 12, 14, whatever, structurally speaking, it's a distinction without a difference, in my opinion. As far as the monthly goes, nothing to write home about for the time being. It basically reflects what we've just mapped out on the quarterly charts, and all the higher time frame charts are very much aligned in that regard, where you've got previous cycles level high specifically at 20k, which is relevant now. 12 to 14k may be relevant later if 20k fails. That's kind of the deep previous cycles levels that we mentioned. As to the upside, where does mean reversion take us? That's kind of the focus on this video. Should we get it? As before, if we look at where this range breakdown took place, it took place at the mid-30s, which seems like a very unrealistic and crazy price to think about now, but that is very much where we came from. That's where the range broke down. So even a bearish retest, from a higher time frame point of view, if there's a sustained or visible counter trend bounce, that's the area to look for. And accordingly, any reclaim or move back inside that value area or back within the range would be the a higher time frame bullish signal, admittedly some way away from here. But we talked about it on the way up, talked about it on the way down, so it's just as relevant now as it was then. I think the weekly time frame is where most weekly bull cases are being built. That is for two reasons. One is, as mentioned, it's pretty much at this prior cycle structure at 20k, also a nice psychological round number. And the other thing that exists at this price level is the 200-week moving average at, I think at the current price, it's around 22k. We've done videos previously based on this 200-week moving average, where historically, from not a massive sample size, but historically nonetheless, you can see that these even aggressive bouts of bear market selling, such as the 6k breakdown or the COVID crash, they've kind of slowed down and or churned around the 200-week moving average, so it's been a useful thing to look at. Again, it's not been perfect from a price point of view, especially the most recent iteration. Before this one violated it by up to 20-30%, but from an eye test point of view, that's certainly where a lot of the selling has slowed down in the past. At face value, that doesn't look very good at the moment, given we've had both a significant discount, which is fine and expected, but we've also had subsequent closes below and through that same 200-week moving average. So looking at the evidence in front of us, it looks like that this support area is broken and or not acting as support at the time of recording or from the available evidence. Now again, as before, to stress that point, the best bullish setups are failed bearish setups. which is to say that if this important structure, and we know it's within a key level given the previous all-time high cycle, if that gets reclaimed, a lot of the fresh bearish positioning or market views expressed below this level rather, will be wrong, and that in itself will be a bullish signal. All of that to say, I think one of the earliest higher time frame bullish signals that could emerge around 20k, if you're not comfortable either buying a discount or doing it outrightly at the level itself, which is fine. For example, that's what I'm doing. I haven't outrightly bought at this level. I do want to see some evidence of strength, absorption, or whatever. I think a weekly reclaim of the 200-week moving average, that is to say, at least a daily, but ideally a weekly close back above it with obvious evidence of imbalance and that the bearish retest has failed, I think that will be a very positive signal to suggest maybe the first visible high time frame sort of counter trend bounce that we've had the entire way down. And again, that's a point I can't quite stress enough, which is how one-sided this trend has been since the top. You might think, well, cred, we got a counter trend bounce here, basically from 30 to 45. Isn't that like a classic example of a lower high before lower low? What do you mean there have been no counter trend bounces? And I think it's important to consider the context as to what happened on this bounce. This was the Lunar Foundation Guard buying BTC. It was one of the most aggressive, kind of spot-driven market catalysts that we've had in some time. And only that, that's the only reason we see it on the chart. And the result of that speaks for itself. It failed, the experiment failed, it blew up, took the market lower. It was the first domino in this whole timeline of systemic risk and contagion and blow up we've had since then. And since then, it's been down only. So without this mega aggressive Terra Luna buying, which took us to zero anyway, we wouldn't have had a single, or it doesn't look like there was any reason for a single counter trend bounce for this entire trend. So this has been very, very aggressive, and that's worth bearing in mind. So it's worth, I think, extending or mapping out where this 200-week moving average lines up, and that's certainly where my attention is for some sort of reclaim of that to suggest a meaningful mean reversion. Now, what do I mean by a meaningful mean reversion? I think other moving averages can be helpful here. So purely in terms of candle structure, if we delete everything, including our levels and this current moving average, just eye test on this type of chart, it's like, where is candle structure? Where would resistance be if we start seeing some visible green candles? I know, shocking, visible green candles on Bitcoin. Seems like a relic of history. At the very least, my eye is drawn towards 30k, right? The previous range low. Because it's been a very inefficient, not really inefficient, it's been quite orderly considering the circumstances, but in terms of kind of volume profile and structurally, it's been just very one-sided selling the entire way down. Up only, you get down only, and down only, you get up only eventually. Both of those are true just as price kind of works its way through those volume clusters and is left with big inefficient moves in price. Once broader direction and even a shorter term trend kicks in, price has a willingness to fill those gaps and clusters quite quickly. So I think any type of even bear market rally, even bearish retest, just something which isn't down only on the higher time frame, I think 30k, 32k is really the first area of interest. And I think that analysis, if anything, it's not just supported by, but it's made to seem conservative with reference to where the medium to high time frame trend proxies line up. So I like to overlay the 21 weekly, 50 weekly, 200 daily moving averages, not as trading signals per se, but just to give me an idea of where the higher time frame mean is. You'll recall from old technical roundup videos on the way up, I used to argue all the time that something you can do in an uptrend actually is to overlay these moving averages and see how far price is above them. And then you can kind of do a quick eye test and see, well, look, if prices what would happen to my portfolio if price kind of fills the gap and comes in to test those moving averages? So let's say price is 10% above them. Then you have to think, well, what would a 10% haircut do to my portfolio? Am I comfortable? Does it make sense to hold my positions if that's the kind of haircut I may have to incur? And if the percentage is small, then the answer is yes. But as the market becomes, more extended and goes 30, 40, 50% above these mean reversion type of proxies, then you might want to reconsider and think, well, look, there's a decent chance the market dips to those moving averages. They're 50% away, and I don't want to give away 50% of my portfolio. So that's sign of how strong the trend has been, maybe I'll take some profit and book it in case the market mean reverts. And I think the same kind of applies in a downtrend as well. If we get any type of visible bounce, and again, that's still an if, as we'll discuss, again, weekly, 200 week needs to be reclaimed for me at the very least. We'll talk about daily structure in a moment. But if we generate some sort of higher time frame visible bounce, the first one in the entire trend from this kind of 20k level, I think you just have a nice cluster of confluence as to where that rally might end up. And this is quintessential crypto. It always undershoots to the overshoots in both directions, to the downside and to the upside. So we can take some liberties and kind of mark out the low to mid 30k area where we have candle structure and medium to high time frame trend proxies as a nice type of target for a bounce. Even if it's a bearish retest, even if it's a counter trend bounce, that's sort of where all roads lead to Rome, so to speak. Now, a funny consideration is that price trading into here would still be technically bearish from a structure point of view. It'd be a bear market rally into presumably a lower high or more consolidation or just into resistance more broadly. But even that kind of bearish scenario is a kind of, depending on how you measure, 60 to 80% move in price. That's kind of just how extended we are. So, on the upside, if these are our moving averages, say I've drawn them here, all three of them, and price is up here, and you measure price relative to the moving averages, you'd think, oh, this is such a strong uptrend. And it is, because it showed, whatever that difference is, it shows you how extended and how quickly price is moving relative to more conservative trend proxies. And it works the other way around as well. So price dipping from up here into the moving averages isn't necessarily a bearish thing. It's a mean reversion, kind of like we had here, right? And price continued to and went on to make a new high afterwards. So it's not an indicator that the trend has changed, that's just the trend is being tested. So this move has been so strong that price even testing the bearish retest would take it 60 to 80% higher from here. That's kind of crazy. Now, as far as we're engaging counterfactuals here. What would be good evidence of price making or moving towards that? Again, I think from a higher time frame point of view, the first clear one is a weekly close above the 200 week. That would suggest that this is all a kind of overextension, deviation, whatever. Close above the 200 week. Your risk is defined that you're wrong more or less at the lows. I'm sure you can tighten it up relevant to whatever candle structure forms. And then you target anywhere from 29, 32, round number, something like that. You target a mean reversion at the very least. Is there another setup that could potentially or that would suggest a larger or visible mean reversion? I think perhaps we can look at the 3-day time frame for this. And the market has been very stair-steppy in that regard, moving in terms of thrust, consolidation, thrust, and so on and so forth. And that pattern has been very good, and the consolidations have been getting shorter, right? This consolidation broke down, went lower. This consolidation went down, broke down, went lower. This consolidation broke down, went lower, so on and so forth. So again, the best bullish setups are failed bearish setups. We'd want to see some observable change in behavior or in how the trend has been developing. So one way we can do that is by marking out the most recent iteration of this quite reliable pattern, which is by, again, taking some liberties, given we're looking at higher timeframes. We can just essentially box out this most recent pre-breakdown range between 20.5k and 21k and say, look, this downtrend has been characterized by consolidations breaking down and following through to the downside. If it breaks down and doesn't follow through to the downside, maybe even reclaims the range, that would be good evidence of some sort of shift in behavior. And what that would look like is, unlike this previous iterations where it just goes and breaks down and keeps going, we'd want to see some sort of range reclaim and either retest or just a range reclaim and acceptance above the prior boundary. And that would suggest to us, again, a shift in behavior and evidence of a larger mean reversion brewing. Your first trouble area or resistance for that, again, would be around 30k. And then your invalidation would be whatever low took place, or even just the extreme of the move before the range was reclaimed. Okay? This analysis, you can pretty much copy paste to ETH. I know it's got slightly different structures, but the levels and especially the 200 week are more or less the same. And as for altcoins, I'm not going to pretend there's some sort of amazing, sexy catalyst, top 10 altcoin gems type of thing going on. I think a lot of the altcoin narratives that we have are dead. Go listen to Technical Roundup, and the most recent one, to hear about the L1 trade or whatever else. I think we can afford to be somewhat cynical here and say that if the Bitcoin and ETH higher time frame setups set up, then you can just kind of take a look at old reliable or whatever altcoins you generally like trading, or something that's liquid and has a good chart, and just pump those if you want some extra risk, some more beta, and potentially some more upside to express that view. As far as macro fundamental calendar stuff goes, July historically, kind of seasonality wise, is good for equities. That may not necessarily be amazing for crypto, as we've seen, even when equities have rallied, crypto has struggled, so whatever. And also July tends to be good because kind of July, August is earnings season. If earnings suck, then maybe the S&P sucks and crypto sucks as well. So there are definitely some provisos attached to that. Macro still looks kind of rough, so maybe it's a good time to filter that noise, and the best we can do is wait for the market to show us what it wants to do. In this case, I think it's either the classic scenario we've covered a million times, where if it goes to zero, which zero just means the 20k breaks down and we have to punt at 14, 12, 10, whatever, those types of apocalypse levels. If that happens, fine. If the market chooses to show strength, I think it's worth looking for a counter trend bounce, simply because of how far away the mean reversion stuff is. Like, the market is so extended that even a bearish retest would be a massive move. What would be evidence of that? Exhibit A reclaim of the 200-week moving average would be good. A weekly close back above it would suggest the first visible counter trend bounce. So if you're conservative and you like higher time frame stuff, weekly, 200 week, just focusing on that will likely generate some signal. For those of you operating on slightly lower time frames, I think this downtrend has been characterized by a rather clear consolidation breakdown type of structure. You want to see a shift in that structure or a shift in behavior to suggest that you might get a move in the other direction, or that the trend is weakening or slowing. And I think the earliest reasonable evidence of that that might emerge, or at least the setup which would present itself in a risk-defined way, would be a reclaim of the 20 to 21k range on the lower time frames. And again, because it's lower time frames, it's less probable, quote-unquote, less confirmation than the 200-week idea, but at least it comes up sooner. It's the classic trade-off. Do you want a faster signal, less confirmation? If so, it's your daily 3-day range idea that we talked about. If you want the slower signal and quote-unquote more confirmation or more probability, it's the 200-week. Otherwise, if it's all a piece of shit, I'll see you in hell, and that's where we bid. Thank you for watching. Hope this is helpful. Do leave a comment if you like these shorter videos, or if this explanation made sense at all. As always, thanks to FTX for supporting the show. Check out the mobile app, buy some altcoins to your family, never talk to them again. It's good to be back. Thank you for your patience while I was sick. I'm still a bit raspy, but it's great to be here in the trenches, making content, and hopefully in the near future, making some trades. That's all from me. Thank you for watching. Take care. Happy 4th of July to our American audience, and see you later.